In this video, I'll provide you with 7 strategies you can use to legally reduce your UK crypto tax bill. We'll also cover tax-efficient company structures and show you an example where 2 crypto investors made the same gain, but one paid far less tax. This is part 2 of a 2-part video. In part 1, we covered when crypto is taxable in the UK, including when you swap or spend it. So if you haven't yet watched that video, I'll link it below. Stay until the end of this video though, as there are 2 key areas where people think they have found a shortcut, but sometimes they have just created a more expensive problem. Strategy 1. Use the £3,000 CGT allowance with timing. For 2026/27, individuals have a £3,000 capital gains tax annual exempt amount, and this is combined across chargeable gains. It is not £3,000 for crypto, £3,000 for shares, and £3,000 for property. It is £3,000 total. Example: you bought crypto for £9,000. You sell it for 11.5k. That is a £2,500 gain. If you have no other gains that year, you may be within the allowance and have no CGT to pay. But if your gain is £10,000, only the first £3,000 is covered. The remaining £7,000 is taxable. Here is the mistake. People hold for years, then sell everything in one tax year. That can waste multiple years of allowances. The allowance does not roll forward. If you don't use it, you lose it. Now combine that with timing. The UK tax year runs from 6th April to 5th April. Sell on 5th April and it falls in the current tax year. Sell on 6th April and it falls in the next tax year. That one-day difference can give you a fresh £3,000 allowance, more time before payment is due, and possibly move you into a lower tax band if your income changes. Example: you are sitting on £6,000 of gains near the end of the tax year. You have no other gains. Instead of realising the whole £6,000 in one tax year, you realise £3,000 of gains before 5th April, then £3,000 after 6th April. You have used 2 years of allowances. Potential CGT, 0, same profit, different timing, different result. And if your income is expected to fall next year, maybe because you are reducing hours, taking time off, retiring or changing work, timing could also mean more of your gain is charged at 18% rather than 24%. Sometimes the most profitable thing you can do is not another trade. It is waiting a few days. Strategy 2. Use your spouse or civil partner. This is one of the simplest legal tools in the UK system. Transfers between spouses and civil partners are usually no gain, no loss. That means you may be able to transfer crypto to your spouse or civil partner before selling. So both of you use your allowances. Your £3,000 allowance plus their £3,000 allowance equals £6,000 of potential tax-free gains in the household. Example: you have a £6,000 crypto gain. If you sell it all yourself, £3,000 may be taxable. But if you transfer the right amount to your spouse first, and you each realise £3,000 of gains, the household may pay no CGT on that gain. Now combine that with the year-end timing strategy. Before 5th April, you and your spouse each realise £3,000 of gains. That is £6,000 sheltered. After 6th April, both allowances reset. You do the same again. That can mean £12,000 of gains, covered across 2 people and 2 tax years. But document it properly. Keep the date, value, reason for the transfer, and make sure your spouse actually understands what is happening. Nothing ruins a romantic evening like the words, "By the way, you may need to file a tax return." Strategy 3. Harvest losses properly. Losses are painful, but for tax, they can be useful. Example: you made a £20,000 gain on one crypto. You also have an £8,000 loss on another. If you sell the loss-making asset properly, your net gain could reduce to £12,000 before allowances. At a 24% CGT rate, that £8,000 loss could save up to £1,920 of tax. But two things matter. First, the loss has to be realised. A loss on screen is not enough. You generally need a disposal, such as selling it, swapping it, or otherwise disposing of it. Second, watch the 30-day rule. If you sell a token to create a loss and buy the same token back within 30 days, the loss may not work the way you expect. So your options might be: wait 31 days, buy a different asset, or get advice before trying anything more advanced, and most importantly, report the loss. An unreported loss is often a wasted loss. You normally have up to 4 years after the end of the tax year of disposal to claim a capital loss. Once validly claimed, unused losses can be carried forward and used against future gains. That can be extremely valuable in the next bull market. Strategy 4. Deduct allowable costs. This is where people quietly overpay. Your gain is not simply sale price minus buy price if there are allowable costs. You may be able to deduct the original cost, certain transaction fees, some exchange fees, professional costs and valuation costs. Example: you sell crypto for £25,000. Your pooled cost is £18,000. At first glance, the gain looks like £7,000, but you also have £500 of allowable fees. Your gain is not £7,000, it is £6,500. At 24%, that £500 of costs could save £120 of tax. That might not sound huge once, but if you make hundreds of trades, pay gas fees, use bridges, use exchanges or use crypto cards, fees can add up quickly. Gas fees are basically the network cost of getting the transaction processed. In tax terms, the key question is whether the cost is allowable for that taxable transaction. So keep records as you go. Not 6 months later, when the exchange CSV has vanished and you're trying to reconstruct your financial life from screenshots. Strategy 5. Understand crypto income allowances. Capital gains are one side, crypto income is the other. Staking, mining, and some DeFi yield can be taxed as income. There is a £1,000 trading and miscellaneous income allowance, and some crypto income can fall into that world. So if you made £1,500 in, for example, staking income for the year, if you use your £1,000 trading allowance, only £500 of that may be taxable. But this is not a free £1,000 crypto bonus in every situation. It depends what other income you have, whether the activity looks like a trade, whether you are already using the allowance elsewhere, and whether claiming the allowance is better than claiming actual expenses. The practical point is simple. Do not mix up crypto income with crypto gains. They are not the same tax calculation. Strategy 6. Crypto ISA. From April 6th, 2026, there's an important change for UK investors using an ISA for crypto exposure. Crypto ETNs, exchange-traded notes linked to assets like Bitcoin or Ethereum, will no longer be something you can newly hold in a normal stocks and shares ISA. Instead, they'll need to sit inside an innovative finance ISA. The tax benefit is still the big attraction. Inside an ISIR, you do not pay tax on income or capital gains from investments, and you do not need to declare gains on your tax return. So if your crypto ETN rises in value inside the account, that growth can be sheltered from capital gains tax, but there are drawbacks. An innovative finance ISIR is less common. Not every platform will offer crypto ETNs through them, and the product itself is still high risk. The FCA has also warned that crypto ETNs will not be covered by the Financial Services Compensation Scheme, so investors need to understand the risks before buying. There is also the old saying of not your keys, not your crypto, that comes to mind. So yes, it can be tax efficient, but it is not risk-free. Do your own research and consult with a professional. Strategy 7. Leave the UK. If things are done correctly, it's possible to leave the UK, become a non-UK tax resident, sell your crypto, and have no UK capital gains tax to pay. This could, in certain cases, be a massive tax saving. However, some people think, I'll just move abroad and sell. Not that simple. UK tax residence is based on the statutory residence test. It is not based on where you post Instagram stories from. But there are several traps. If you leave the UK, sell while non-resident, and return too soon, temporary non-residence rules can bring certain gains back into UK tax. In many cases, if you return within 5 years, you may still have a problem. So yes, leaving the UK can be part of serious tax planning, but booking a flight after your coin pumps is not a tax strategy. You also need to consider the tax rules of the new country too. And planning does not just mean tax. You also need to think about lifestyle. Can you actually stay away long enough? What about family, friends, healthcare, visas, language, safety, local taxes, banking, and quality of life? Saving tax is not much good if you hate the life you created to save it. So, if you are considering this option, make sure you get proper advice tailored to your personal situation and plan carefully. And if you would like to find out more about this, we will have another video that goes into more depth on the subject and link it below. Limited company versus personal. Should I hold crypto personally or in a limited company? The answer is, it depends what you want the money for. Personally, you get the £3,000 CGT allowance. Crypto gains are generally taxed at 18% or 24%, depending on your income and bands, and crypto income is taxed at the income tax rates. Inside a limited company, there is no personal CGT allowance. The company pays corporation tax on its profits and chargeable gains. For 2026, that can be 19% for small profits and 25% for higher profits, with marginal relief between those levels. Also, swapping one crypto for another can still create a taxable event inside a company. There is no magic exemption just because the company did it. The difference is how the tax is calculated, reported, and eventually extracted. And here is the big trap. If you want to take the money out personally, you may pay further tax through dividends or salary. So a company is not a discount code. It is a different container. A company can make sense if you are trading at scale, reinvesting profits, building a crypto-related business, or keeping funds inside the company for the long term. But if your plan is to sell crypto and spend the money personally, a company can add accounting costs, admin, company's house filings, corporation tax, and a second layer of tax when you extract the funds. Think of a limited company like a holding tank. It can be useful if the profits stay inside and keep being reused. But if you keep draining the tank for personal spending, the advantage can leak away. So don't set up a company just because someone online said companies pay less tax. That sentence has created a lot of expensive accounting bills. Tax saving is not always the same as making more money. This is important. A tax-efficient decision is not always the best investment decision. The goal for most people is not to pay the least tax possible. The goal is to maximize your overall return. Example: you bought a coin for £1,000. It is now worth £4,000. If you sell now, you make a £3,000 gain. If you have no other gains, that could be covered by your annual capital gains tax allowance. So from a tax point of view, that looks efficient. No CGT. You keep the £3,000 profit. But what if that coin later goes to £20,000? If you had held it, your gain would be £19,000. After the £3,000 allowance, £16,000 could be taxable. At 24%, that would be £3,840 of tax. That sounds painful, but after tax, you still keep £15,160 of profit, compared to just £3,000. That is much better than selling early just to pay no tax. So use these strategies like cards in your hand, not the whole game. They are options to consider when building your overall plan, and are not a concrete reason for why you should buy, sell, invest in a certain way, or move abroad. Two investors, same profit, different tax bill. With that being said, let's bring this all together and see how two investors can make the same profit, but one pays far less tax than the other. Investor A makes £48,000 of crypto gains. They sell everything in one tax year. They use their £3,000 allowance. That leaves £45,000 potentially taxable. If all of that falls at 24%, the CGT bill is £10,800. Investor B also has £48,000 of gains, but they plan. Before 5th April, they realise £3,000 of gains personally and transfer crypto to their spouse, who also realises £3,000. That is £6,000 sheltered. After 6th April, both allowances reset. They do the same again. Now £12,000 of gains may be covered across two people and 2 tax years. That leaves £36,000. Then they crystallise £9,000 of genuine losses from another asset without buying the same asset back inside 30 days. Now the taxable gain is £27,000. If that is taxed at 24%, the CGT bill is £6,480. Investor A, £10,800. Investor B, £6,480. That is a £4,320 difference. Same market, same total gain, different planning. This is why Crypto Tax UK planning matters before you press sell, not after. Now, here are a couple of best practices for you. 1. Keep accurate records and do it in a timely manner. Not 6 months later when the records are harder to get hold of or you have forgotten what you did. 2. Consult with a tax professional regarding your personal situation. Because this video is for entertainment and education purposes only. Although we are accountants, this is not personal tax or finance advice. And if you missed part 1 of this video, where I explained the crypto tax rules, it's linked below. If you would like to find out more about UK crypto tax, make sure you subscribe. Thanks for watching.